Hi guys and welcome! Today we talk about options and in particular about the Iron Shark strategy. I am Francesco Placci, Research and Development Manager for the Unger Academy. Many of you have asked us for an update on the Iron Shark strategy, so let's see together its behavior in out of sample. And please, if you want to stay up to date on our videos, subscribe to our channel. Well, this is the backtest of the Iron Shark strategy from 2010 until today. What is the Iron Shark strategy? It is a delta neutral strategy that aims to sell options to collect theta, the passage of time. I use it primarily on the SPX options, and its peculiarity is that it has inside a sort of protection against adverse events, the so-called black swans events, which can be very dangerous for option sellers. It is a strategy that is always on the market, except for those rare cases, as explained within the training program, during which our filters, based on the volatility term structure, tell us that it's not the time to sell options because excessively risky. I designed the strategy in early 2017 and I've been using it ever since. And you can see in this graph three different colored areas, blue, pink and yellow, which correspond to three different periods. In particular, we can consider the blue area the in-sample period, while the pink area corresponds to the first out-of-sample period after the workshop of 2018, and the yellow area represents the second out-of-sample period after the release of the Iron Shark program with the Unger Academy. We can see a good regularity of the equity line, but certainly due to the greater volatility that markets have shown in the last 2 years, the final part of the equity line is certainly less smooth but equally profitable. Why that? Because from 2010 until 2017 the markets have not experienced collapses except a decline in August 2015 that lasted a few days. While in 2018 we saw two major crashes in January and between October and December, and also in 2020 we experienced one of the worst declines in the market for its strength and speed. So let's have a look at the statistics. We see that 223 trades have been made with a total gain of about $92,000. The profit factor is 3.7 and profitable trades are about 77%. The max drawdown of the strategy is slightly higher than $4,000, but it is a drawdown close to close, so we must consider that the intra-trade drawdown can be at least 50% higher. The margin required by the brokers to trade this strategy is about $15,000 using portfolio margin account or the options on a mini S&P 500 future, and the return of the strategy from 2010 until today corresponds to about 600% of the margin required. For those instead who use the classic T-reg margin, the return is reduced to 200%, which corresponds to about 20% per year, which I think remains a respectable result. Okay guys, so if you want to learn how to build trading systems like Andrea Unger, the only 4-time trading world champion with real money, go ahead and click on the link below. It's our free webinar during which you will see the steps to build your trading systems and become a profitable trader, how to have an edge over other traders and professionals in the sector, and how to build a diversified portfolio of automated strategies. Finally, if you liked this video, press like and then subscribe to our channel.